Welcome to the Capital News. I am your host, Alex Kreitis. Today is May 2nd, 2019. Thank you so much for joining me today. Hope everyone out there is doing well. So what happened with the stock market today? Well, the S&P closed down 6 points. The Dow was down 122. The NASDAQ closed down 13. And the Russell 2000, the small cap index, inched up 6 points for the day. Oil, we continue this story of quote-unquote surging stockpiles because production is just rampant here in the United States. At least those are the headlines. And so oil took another dip and is now at $61.85. Brent, meanwhile, is at $70.62. So that's also taking a beating over the last couple of days here. Gold is still below our $1,300 an ounce benchmark and sits at $1,272. Silver is also below our $15 benchmark and sits at $14.61. Again, the reason we're talking about silver benchmark at $15 is generally that is the cost of mining. So that's sort of the break-even cost for a lot of miners out there. At least that's what I've read through various sources and articles. So I'm sort of taking that as gospel truth when it comes to silver. Gold, on the other hand, the $1,300 an ounce, that's more of a technical level that we've seen recently. So gold is still trading right around that, but it has been to the downside as of late. That's more or less on the back of a strengthening U.S. dollar. The VIX, the volatility index, was down 2.5 percentage points and now sits at $14.42. The stock market here across the indices, well, they tried to stage a late day rally. And for the most part, they were able to do so. However, the S&P, the Dow, and the NASDAQ were unable to enter into positive territory. The Russell was down nearly 1 percentage point on the day, but it was able to stage a comeback and closed up 6 points for the day. So this is all interesting. This is a continuation sort of yesterday's sell-off. This is off of the back of the comments from Jay Powell, the Federal Reserve Chairman, with his press conference yesterday highlighting the news that came out of the Federal Reserve's two-day interest rate policy meeting. And as was expected, and then following the discussion we had yesterday, we anticipated that the Federal Reserve was going to remain in their current status with the wait-and-see approach, be data-dependent. This was pretty much priced in from the markets. This was what the vast majority of market participants were anticipating was going to happen, and it did. We did have a little bit of drama, obviously, with the president coming out and tweeting what he tweeted in regards to following China, their great stimulus program, and, and they're keeping interest rates low, but he didn't want to just lower interest rates. And again, it wasn't just by 50 basis points, because that's what we were hearing from the likes of Stephen Moore, Larry Kudlow, and the president himself. Not just 50 basis points, but 100 basis points, a full 1% drop in the federal rate. And with a kicker, the Federal Reserve should also embark on another round of quantitative easing, which would mean it would be quantitative easing round number 4. Again, you can't have both statements working together because they're at odds with each other. You can't have, on one hand, we have 3.2% GDP, the greatest economy ever, record low unemployment, productivity up, manufacturing jobs coming back, everything's just fantastic, tax cuts, deregulation, a whole host of it, and then say at the same time we need to lower interest rates and the Federal Reserve needs to embark on a emergency measure, quantitative easing. It makes no sense. So we ran through that background the past couple of days. I'm not going to bore you with it again, but nevertheless, I will bring it up again because this program is obviously growing. Thank you guys out there. And so I'm going to have to, retouch on some points. And just as a refresher as to what's going on, I will bring it up again as to what the president, I think, is ultimately doing here, trying to dance himself out of the box that he's placed himself in, taking ownership of the economy and the stock market, and also trying to box in the Federal Reserve. And if this market and/or stock and/or economy rolls over, he's going to blame it at the feet of the Federal Reserve. And I also think he's going to blame it on the Democrats. But I'm going to have a further discussion on the political implications on today's episode dealing with the political geopolitical report. So check that out. That should be episode 60 A. We're going to go into a more in-depth discussion on the political ramifications of some of this stuff. So what I want to discuss today here regarding the economic report is a follow-up to our discussion regarding valuations. Are these market caps of some of these companies, are they sustainable? We have the likes of Microsoft and Apple hitting $1 trillion market cap. They're trading around it. I mean, they're both well north of $900 billion market caps. Again, depending on how the stock is trading is whether or not it's going to hit $1 trillion. Microsoft did so the other day. I believe it's pulled back a little bit, as has Apple. But nevertheless, they are well north of 900, very shy, just shy of the $1 trillion mark, and it could hit it at any point once again. But the question still remains, is it sustainable? Is anybody even asking the question? I mean, if you look at the financial mainstream media, this is basically something for everybody to high five and pat each other on the back. Like, can they do it? Can we get $1 trillion? Without asking the question, is it sustainable? I'm not here to be a party pooper. I'm just simply asking a question. It's my opinion that no, they are not sustainable, because I am simply looking at the genesis as to how they got to be there in the first place. And I attribute a lot of this to the counterfeit money that has been taking place for nearly a decade, not just from the Federal Reserve, but from central banks the world over. And that is what is giving rise to these market valuations, which to me are overheated. They are. That doesn't mean that the market can't continue higher. It doesn't mean that Larry Fink, the CEO of BlackRock, that his prediction, or at least possible outcome, of a stock market melts up, not a meltdown, but a melt up, is possible. It is. It most definitely is. There's money that's sitting on the sidelines. There is money that exists in other financial assets, commodities, real estate, bonds. That money can rotate. It can leave those assets and enter into the stock market, and we can continue to make all-time highs. Again, we are making all-time highs on the S&P. We are making all-time highs on the NASDAQ. The Dow Jones Industrial Average is still, now it's about 600 points shy of that. And the Russell 2000 is still about almost a couple hundred points away from its all-time high. So there's still some gaining to do with some of these indices. But nevertheless, the question still remains, is it sustainable? Can we make all-time highs with some of the other ones, the Dow and the Russell? Yeah, it's possible, folks. It can happen. I think what it's most likely to be is it will turn out to be what is called a bull trap, and that just simply means people think that we are in a bull market, and they just want to get in on the action. They don't, fear of missing out. And what's going to happen is they are going to buy high and end up selling lower, the exact opposite of what they're supposed to do. Good investors are supposed to buy low and sell high, but people tend to think the other way. They're afraid of missing out. They don't want to miss out, because their neighbor got in a little lower and they're making money and they're jealous. It's all behavioral. It's all petty stuff. But guess what? That's the markets run off of emotion. Couple that with the fact that we're in the financial world of Oz, and that's a recipe for disaster. That's why I'm telling everybody, you have to be prepared. You have to have a plan. You have to be diversified. This market can't continue. The simple question is, do you have the risk tolerance for it? Can you stomach the volatility? Is the risk-reward trade-off worth it for you to really put all of your eggs in one basket and say, yeah, this is a bull market. It's going to continue. We are going to continue to make new highs day after day, week after week. You can believe that. That's fine. I'm going to have a disagreement with you, but that's what it's all about, right? So I'm simply here to offer my opinion, my guidance in some things, what I'm doing personally. Again, you have to do your own research, do your own homework. I'm not here to tell you what to do or how to think. Quite the contrary. I'm here to tell you guys to think independently. Don't simply listen to me and take me at my word. Do your own homework. Don't just simply turn on Fox News or MSNBC or CNN or CNBC or Bloomberg and just listen to those people, the quote-unquote experts, and take them at their word. Do your own homework. Ask some simple questions. Does this make sense? Provide some perspective to what they're saying, because they might have some sort of agenda that you're not aware of. So don't just follow people blindly. Doesn't matter what the resume is. It seriously doesn't. We have a bunch of people who make a lot of money, but guess how they're making that money? I mean, a lot of it's fraudulently. we have the central bank printing funny money. It goes somewhere. That to me is fraud. This to me, that the definition of inflation is an increase in the money supply. That's exactly what we have seen over the past decade. That is inflation. But of course, we're told that there is no inflation, that it's only 1.5%, 1.8%, right around 2%, somewhere around there. Nothing to worry about, right? It's a bunch of baloney. But we have to understand what the puppet masters are telling us, because that's sort of how they're making their decision. So while it's all noise, while it's a lot of propaganda, we have to pay attention to it, because that's how the markets behave. They're looking to these people to make their own decisions. Again, that is a travesty in and of itself. The fact that it's even called a central bank right there in the name should warrant enough skepticism that it never should have come into existence in the first place, which is why we advocate here strongly for the end of the Fed. End the Fed. Abolish the Federal Reserve. It doesn't need to exist. We don't need a bunch of egghead academics sitting around a table telling us what the cost of capital should be via interest rate policy. There's no reason. There's no rhyme or reason. We don't have the central bank of oil sitting around telling us what the price of oil should be. We don't have a central bank of lumber telling us what the price of lumber should be. And the list goes on and on and on. A whole bunch of commodities, a whole bunch of financial assets. We don't need centralized institutions around here telling us what to do. In fact, that's the antithesis of the United States of America. If they want to have these types of institutions elsewhere, that's their business. I'm not here to tell other countries how to run their business. But this is my country. This is the United States of America. We don't have these types of centralized institutions. That's why this is not a free market economy, ladies and gentlemen. This is not free market capitalism. This is corporatism. This is socialism. It's a hybrid of both of them. This is what you have to understand. Unless and until you understand that fact, you're never going to understand the fraud that is the Federal Reserve. You're not going to fully understand and appreciate the fraud that is the income tax. And unless and until you get rid of both of those things, the Federal Reserve and the income tax, you will not solve a damn thing. No ifs, ands, or buts about it. You're just going to put a Band-Aid on a bullet wound. You're just going to kick the can further down the road for somebody else to deal with, which is not good policy. It is not good leadership. It is the absence of leadership. It is the absence of good policy. And that is a travesty, but that's the world in which we live in. Now, if we don't tackle these things and solve them as adults in a bipartisan manner, whatever you want to say, then the market's going to solve it for us. And the market will show no mercy. At least maybe, politically speaking, you can have people come together and devise a plan, and then you can set expectations. The market loves some type of certainty. It likes expectations because then you have a benchmark. Well, are we meeting our goals? Are we exceeding them? Are we behind? And then you can work from there. The market doesn't like uncertainty. That's why we had a whole bunch of, the sell-off in the fourth quarter of 2018, among a myriad of other issues also that drove that decline. But nevertheless, there was a whole bunch of uncertainty, and the markets don't like it. Small businesses, mid-sized businesses, large businesses, they don't like uncertainty because they're trying to set budgets. They need to know, do I need to hire people? Do I need to lay people off? Do we just need to sort of, be in a wait-and-see mode? What are we going to do? Do I have to go out and make some bigger risks, or do I sit tight and see what happens? I mean, this is the problem when you have people pulling the levers of the economy like this. That in and of itself proves that this is not a free market capitalistic system, because the capital is just being printed into existence. That ain't capital. That's counterfeit currency. You don't have centralized authorities dictating what happens in the marketplace. You just don't. What's supposed to happen in a free market capitalistic system is prices are supposed to lead to price discovery. The interactions of you and me and everybody else getting together, buying and selling, is supposed to find fair market value, and that's where we're supposed to be. The amount of malinvestment that exists in the system because of the funny money, and all that means is malinvestment is people going out further on the risk curve, doing things that they otherwise would not have done, but they do because they have the funny money. A lot of us, the average Joe, doesn't have access to the funny money, especially not large quantities of it. But guess who does? The government does. Banks do. Major corporations do. Big investment firms do. Hedge funds do. This is why you have the income inequality. This is why it is at extremes. This is why you have the likes of Ray Dalio, the founder of the largest hedge fund, $160 billion in assets under management, Bridgewater Associates, out there saying, look, this ain't good. This ain't a pretty picture. Because what they do, they're pretty much the masters of diversification, and they're very much students of economic and financial history. And so when Ray Dalio and company speaks, I tend to listen. Now, again, I don't follow him or anybody else blindly, but I think it's worth taking a listen when he speaks. I mean, you don't have $160 billion in assets under management by being an idiot. I mean, quite the contrary. So whatever they're doing seems to be working to some extent. So when he comes out and they issue warnings saying, look, this income inequality, this is a problem. It's been a problem the world over. Every time it happens, it doesn't end well. And then you had the recent report that we discussed a couple weeks ago in regards to Ray Dalio and company saying, look, we anticipate that U.S. corporate profit margins have peaked. And we're not going to be surprised if we start to see a decline of asset prices of equities as much as 40%. Now, that's in alignment with what we've been saying here consistently for quite a while. I'm anticipating at the very least stock prices are going to go back to the 2016 levels. I really think they're going to be much, much lower than that. And so let's get to that because I did want to obviously have a conversation with stock market valuations. Real quickly, because we are in the midst of IPO season here. We had Lyft come out. We had that conversation. You know, this is very reminiscent of the dot-com era and the dot-com bubble, where everybody was just clinging to hope, once again, which is what we're doing right now, clinging to hope, that you have these companies, they're out there, revenue's growing, but they're not making money. There's no bottom line growth. In fact, they're losing money. So don't worry about that, is what we're told. Don't worry that these companies are not making a profit. Not breaking even, that they're losing money. No. Don't look there. That doesn't matter. Just look how much revenue yeah, but how much is the cost of revenue? You're supposed to be making a profit. A profit is not a four-letter word. You shouldn't be afraid of it. And profit is what drives sustainability. All right? That's how it works. Now, of course, you can go out there and try to convince as many people as you want. Look, this company is great. Look at the revenue growth. We're going to, it's just a matter of time before we catch our feet here. We're going to hit the ground running, and then we're going to make profits, hand over fist. You can sell that. People buy it. But you just look at Lyft, the rideshare company, and, they IPO'd. They, during that day, and they went up extremely high. They touched $88.60 at the high. But now their low was $54.32. So you went from 88 all the way down to 54. It now trades at $61.50. It has a market cap north of $17 billion. $17 billion is its market cap. It loses $911 million. You do the math on that one. See if that makes sense to you. Is that a fair valuation? I don't know. I don't think it is. I don't think that's sustainable. I don't think you can continue to lose money and have a multi-billion-dollar market cap. Meanwhile, we had Beyond Meat come out, and this is basically a company that that has meat products that aren't meat. They're meatless. They're basically plant-based. I'm not knocking this company. I'm not knocking Lyft either. I'm just talking about the valuations. They IPO'd today. Beyond Meat did. $45.10. They traded up to $72, almost $73 a share. But now they're sitting at $65.75. That's where they settled for the day. And they have a $3.8 billion market cap. Meanwhile, they lose $29 million a year, given their most recent quarterly filing, which obviously they had to submit out there for today since they are an IPO. So are these things sustainable? I don't think they are. I just think this goes to the previous comment we made regarding malinvestment. There's a lot of funny money out there. People are trying to put it somewhere. Oh, yeah, this is interesting. Lyft. Yeah, I see people with, the Lyft sticker on a car and, they're driving all over the place. Obviously, it's a good company. And then you look at the financials and, oh, well, they have revenue. They got top-line growth. But what about the profits? Not there. We have Beyond Meat. Well, it's a good idea. Is it sustainable? Maybe it's going to be greener for the planet. Maybe that's a better thing. Okay. You can think that. $3.8 billion market cap. How much money are they making? Oh, they're not making any money yet. They're losing $29 million. This can turn around. I'm not knocking these companies. I'm just simply talking about the environment in which we live Is this a sign of malinvestment? Because waiting in the wings is Uber, okay? That's the granddaddy of rideshare, all right? They're going to put Lyft to shame. The question is, are they going to collapse like Lyft did very shortly thereafter? That's going to be the question, because they lose even more money. So the logic would fit. The more money you lose, the bigger market cap you will have. Makes absolutely no sense, but that's where we're living. That's what happens. Now, getting further with our discussion regarding stock valuations. Some of you may be familiar with Robert Shiller. He is an economist out of Yale, a Nobel laureate. He has devised a handful of things. You might see him like with real estate, the Shiller Index, and a whole bunch of things like that. He's out there with that. But he also has something that deals with stock market valuations, and I believe this is what he won the Nobel Prize for. And it's basically the Cape-Shiller Index, and that just simply stands for CAPE, C-A-P-E, cyclically adjusted P/E ratio. And he does this. He looks at price-to-earnings ratio based off of inflation-adjusted earnings from the previous 10 years. So he's basically trying to level out some of the volatility by going back 10 years. So you can look this up online. It's readily available. But this is a measure of stock valuations. Now, like anything out there, some people really put a lot of weight on the Shiller P/E ratio. Other people poo-poo it and say, it's not really a good metric. It's outdated now. It doesn't make a lot of sense because a whole host of other things out there. That's like anything, okay? To me here at the Capital News, it's simply another piece of the economic puzzle. And it's something to look at to see, well, net, where are we likely to be headed? Are we going to the upside? Are we going to simply be range bound for a little bit and stagnate? Or are we going to go down, up? What's the question? I mean, that's what we're talking about here. If you look at this, all right, just by the simple arithmetic of it, it will run right now from either 0 to 45. That's your range, okay? And again, it's just simply predicated off of his formula as to where it's going to be. If you go back to 1929, Black Tuesday, this is the start basically of the Great Depression, you had the Shiller P/E ratio of about 30, okay? Black Tuesday, the Great Depression, Shiller P/E ratio at 30, all right? We go forward. Now we're at Black Monday. That's the 1987 crash of 20-some%, the largest one-day drop in stock market history, okay? On Black Monday in 1987, you had a Shiller P/E ratio of just a little north of 15. Let's call it probably about 17, I guess, here, if I'm looking at this, just eyeballing it. All right? So quite the difference, but nevertheless, it was a major drop-off. Now, it set a record high during the dot-com era, and it was all the way up at 44. All right? Shiller P/E ratio up to 44 during the dot-com era. 2008, 2009, you're talking a little bit north of 25. Let's call it 26, 27. Okay, just eyeballing it here on this graph. Where are we today? We're at 30.75. 30.75 on the Shiller P/E ratio. Now, what does all of this mean? Well, if you simply look at the graph, you'd scratch your head and you'd say, oh my goodness, there was only really a couple times in history that it was higher than where it was today. What are those two times? Last quarter, 2018, Q4 2018, and the dot-com era. So is this a forward indicator? What's going on here? I mean, is this stock market going to roll over? Is the economy going to roll over? I mean, again, I'm not saying that the Shiller P/E ratio is the end-all, be-all. In fact, I'm saying the opposite. It isn't the end-all, be-all, but it's simply another piece of the economic puzzle that I think warrants taking a look at to see what's likely to happen. When you talk about this in conjunction with companies that have trillion-dollar market caps, Microsoft, Apple, Amazon was close, Google was close, although they've had some big sell-offs here recently. We had that discussion with their recent earnings come out. How sustainable is it? Because when we had the discussion on this previously, we talked about some other major corporations, such as ExxonMobil, which is about 300, 400 billion, depending on where the price is. So, I mean, does it make sense that these technology firms have trillion-dollar market caps? Does it make sense that the likes of Lyft and Beyond Meat and what's going to happen with Uber, does that make sense? Is it sustainable? It's a question we have to ask ourselves, and we have to prepare accordingly. Time will tell, like it always does. Have a plan. Be prepared. Stick with it, and stick with the Capital News. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you as always. Please like, share, subscribe, get the word out, leave your comments. We would love to hear from you. This is the Capital News. I am Alex Kreitis. Godspeed.